Hey, and welcome to my channel Fiscal Voyage. I'm Felix, and today we're going to talk about McKesson Corporation. McKesson Corporation was suggested by Nashao Nadwin. Sorry if I'm mispronouncing that, but thank you for suggesting this company. If this is the first time you're here on my channel, make sure to leave a comment and suggest a particular company that you would like to see it analyzed next. So with that, let's do McKesson Corporation. We're going to determine if it's a buy, hold, or sell at current prices coming right now.
All right, let's get started with the 5-minute stock analysis on McKesson Corporation, financed at stock exchange as MCK. The company is a distributing pharmaceutical and providing health information technology, medical supplies, and care management tools. McKesson is based in Irving, Texas, and distributes health care systems, medical supplies, and pharmaceutical products. It also provides extensive network infrastructure for the healthcare industry. Also, is an early adopter of the technologies like barcode scanning for distribution, pharmacy robotics, and RFID tags. It's a Fortune 500 company and it is the sixth highest revenue generating company in the United States. So that's saying something there, and we'll see shortly. Fundamentally, the company grew its revenue at 7.83% from 2010 to 2019. FYI, the fiscal year ends on March, so this is basically fiscal year 2009 and 2018, but it ends, basically in the following year. Net income grew in that time rate at a negative 33.08%. S&P credit rating at a triple B plus, so investment grade, and operating income grew at 5.60%. Earnings, however, has a much better growth rate at 12.83% compared to the revenue and net income, which was negative. However, the last 5-year average earnings has been slowing down at 5.13%. If we continue with the fundamentals, last year for fiscal year 2018, they had an adjusted earning of $13.57. These distribution companies, pharmaceutical distribution, tend to have very low margin, but they generate an enormous amount of revenue. As you can see here, margin came in for 2018 at 0.02, and 2017 fiscal year, it was at 0.3, so it's very, very compressed. Return on equity is also not so great at 0.38%. However, they do have a decent debt to cap ratio at 54%. And the current yield of 1.15% is not that great. I like to see companies higher, 3.5, 3, maybe even 2.5% or higher. They do have a very low payout ratio at 11.41%, so they are capable of increasing the dividend substantially in the coming years. And actually, they have a 5-year growth rate at 10.66%. So they have been increasing. However, the most recent increase came in July of this year, which was 5.1%. So it looks like they're slowing down, but they have plenty of room to grow it at a good rate. And they've been growing it for 12 years consecutively. The charter rule comes in at 11.81, just below the what I like to look for at 12 or higher. And that's which is the current yield plus the 5-year dividend growth rate. So future outlook for fiscal year 2019, analysts expects an earnings of $14.37, and fiscal year 2020 at $15.47. So it's much higher than fiscal year 18, which was $13.57. So it is on the right track or trend. Earnings are higher, so therefore price follows earnings. CFRA projects a compound annual growth rate of 5%. My dividend drill return model coming in at 12.2% of future return projection. Currently, the company has a very low PE of 10.11 and with a forward PE of 9.32. That's exactly how I like to look at PEs, where current PE is slightly higher than forward PE. and the 5-year P average is 12.29. So based on this alone, it says that the company is undervalued. So if we look at the fast graph of McKesson, you can see here the black line is the monthly closing price, the blue is the normal PE, and the orange is the earnings with a PE multiple of 15. So you can see here the company tends to follow a normal PE of 14.19, and right now is at a PE of 10. So it's much lower than the normal PE. So with just by this, it says that look at the graph, that the company is undervalued. So let's see how undervalued it is. CFRA has a fair value estimate of 162, Morningstar at 150, Fast Graph at 172, Yahoo at 155, and my dividend discount model analysis at 88. That came low because of the low dividend yield and the slightly low, 10% to the most recent 5% increase. So this gave me $88. So averaging out the 5, we come a fair price of $145.62. And currently you get the company at 143. So it's slightly undervalued based on this, but I think it's this 1.57% is came up because of the low dividend discount model analysis of 88. If they were growing dividends at a higher rate, this would be much more, maybe 10% undervalued. But with that, I recommend this company as a buy. It's been growing dividends for 12 years. It has a nice 5-year growth rate of a little bit above 10%. Like I said, I don't like the yield at current prices, but earnings are expected to be higher. The DDRM analysis came at 12.2%, I think it was, which is great return. The company, is in healthcare, so that's not going anywhere. So it looks good at this price. I wouldn't buy a whole bunch of shares, maybe start a position because of the low yield, but it's definitely undervalued right now, and it has potential to give you, 12 plus return going forward. So therefore, I think of it as a buy at current prices. So with that, if you have a company you would like me to analyze next, let me know in the comments. Give me the name of the company and the stock symbol. And thank you for watching. And if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. And my portfolio, you can find it in the description. There's a link for it. And don't forget to check out the website fiscalvoyage.com. Thank you and have a great day.